So can you flow all of your income through a life insurance policy, whether it be on the personal side of things or as a business owner? The answer to that question, can you flow all of your money through a life insurance policy, is yes. You can do that. A policy can be set up where you can get all of your income into that life insurance policy and then borrow against it for living expenses or for business expenses, depending on what purpose you're using it for. However, if I'm you in that situation and I ask, can I flow all of my income through a life insurance policy? The answer, yes, you can, but I would ask, should I? Does it make sense? Or do the numbers make sense? That's really what I am interested in. Today, we're going to look at a case study that will examine that. So, flowing all income through a policy from a concept standpoint, why people are attracted to this is because I can keep all of my money at work for me. With a whole life insurance policy, when looking at the cash value component, I've got constant compounding, meaning your money is always at work for you. For example, you flow $100,000 through the cash value of your life insurance policy. Let's assume you make a large PUA payment, you've got $100,000 the next day. Now that you've got that $100,000 in cash value, it's compounding for you indefinitely. What this means is if you elect to take a loan against that $100,000, you've got 100, let's say you loan $80,000. The full 100 continues to earn dividends and interest. It is forever compounding. The money's at work. That is why people are attracted to this concept. However, what we have to account for when we ask this question, do the numbers make sense? Is the $80,000 we borrowed, or whatever the amount is that we borrowed, how much did we pay in loan interest? We need to make sure we look at that and other factors, and we're going to look at an example of that today. So to provide some awareness, we've got a couple points and questions here. Point number one, the early years equal negative cash value. Regardless of how well that policy is designed, you will often see a negative cash value in the first year. Let's assume you fund a policy with $100,000 per year. Nice round number. We'll assume your income is $100,000. You fund $100,000 to your policy. If the policy is designed with a minimum premium and maximum cash value, you'll have anywhere between $80,000 and $90,000 in cash value in the first year. Let's assume it's 90. You paid in 100, you have 90. Is that a positive return? No. You took a $10,000 hit in that year. Now you do have a life insurance benefit. The insurance company will say, you're purchasing a life insurance policy here. That's why you've got that hit. But if you're laser focused on the cash value, you do take that $10,000 hit. So if I need to live on my $100,000 of income and I've got a negative hit right out of the gates, I want to have awareness on that, and I wouldn't want to do that strategy if it's going to inflict financial pain or stress. If I'm stressed out and losing sleep over it, the strategy doesn't work in the majority of cases. Another point here, the cost to borrow, the loan interest specifically. Does it exceed the growth in the policy? Going back to the example of $100,000 in cash value, and I borrowed $80,000, what I would want to look at specifically there is what is the growth? What's the net dollar amount I am receiving from the insurance company on that $100,000? And then how much am I paying them in loan interest on the $80,000 that is outstanding? And if I have a different amount in loans outstanding, what's the net dollar amount I'm paying them? I want to be able to see those numbers before I make a decision, because that is where people often have buyer's remorse or regret not having full transparency on what the numbers are before executing any loan strategy, even if it's not all of their income, which typically I'm not a fan of, not putting all of your income through a policy for a number of reasons. A couple questions here. How will I pay the loan interest? How will I repay the loan? If you're flowing 100% of your income through premium and PUA dollars, what is left over to service the loan interest and loan principal? Maybe I fund the policy with 70 or 80% of my income and leave a little bit left over to service the loans. Or maybe I fund my policy with 10% of my income, excess savings, work my way into it, and then use the policy without any pressure on my life from a financial standpoint. I hope that makes sense. But with these two questions, an answer that comes up sometimes is what we have here in purple. Well, if my income increases, I can use the increases to repay the loan and service the loan interest. If I have any bonuses, I can service the loan that way. I'm expecting a windfall, or I set a percentage of my income aside to service the loans as the years pass. How about this question? What if my income doesn't increase every year, or if it does not increase as expected, and I have a large loan outstanding? What can I do here? Well, one thing you can do is reduce the dollars you have going toward your PUA rider and redirect them toward loan payments. We've got a video above that goes over how to do that with the policy. It's a pretty fun case study. So what we're going to look at is a case study. We've got policy A and policy B. These will be two different products, but on the same individual and with the same company. What we're going to look at here in policy A is $100K per year for 10 years. We're starting at age 40. This will take funding up until age 50. And then policy B will be $100,000 per year for 25 years up until retirement age of 65. Let's take a look here. First, we'll take a look at the two policies side by side, and we'll start with policy A. So as we look at this, what do we have? Annual funding, $100K per year. This is me. Before I look at any loan strategy, my question would be this: where? Where is my money going? Here's my base premium. Here's my PUA rider. So this is a 10-90 split, 10% premium, 90% PUA. First year cash value, just about 90%. So if my strategy is to borrow against this for income purposes, I took a $10,000 hit right out of the gates. Another item of awareness. Do you have access to 100% of your cash value for loans? Typically not 100%. Some companies it's very close, but a lot of times it's right around 95% or so. So it's going to reduce things even a little bit more. Next year, what happens? Paying $100,000. It was 89 and change, and it grew to 186 and change. Did you get your full 100 back? No, you did not. And you can actually see that over here with the annual internal rate of return. If it's in the red, that means I got less back than what I paid into the policy that year. Next year, I pay in 100, get my 100 back and a little bit more. You see the borders here because I break even. I've got more than my total payments at year 4. That's a strong break-even point. And fund it through year 10. And there's the annual internal rate of return as the years pass. That is policy A. Let's look at policy B. Again, same company, same design, but different product that allows for a longer funding period. So, 100K, first year cash value, over 90%, $92,000 and change. Break even, not quite as strong, between years 4 and 5. Now I will have more money in this policy because I paid more into it, $2.5 million total compared to $1 million. But what do you notice when you look at these columns? The internal rate of return is lower with this example. That is a very important item to be aware of because it's important to a lot of people. I know working with individuals considering larger policies, whether it's $500,000 or $1 million plus per year, or corporations, a lot of attention is given to this and the growth rate on a policy. So one may look at a situation like this and say, you know what? Instead of going with an option where I'm going to pump a lot of money in for a long time, let me go with an option like this. When I take loans, I'll pay the loan interest only, and then I'll have a large loan balance in year 11. And what I'll do at that point in time is begin to redirect money I was paying toward the premium toward my loan principal. So now my cash flow is effectively the same, but I'm redirecting it toward a different area. That's one option. What you could also do over here is after 10 years, perhaps you reduce your PUA payment to $40,000. So now I'm paying a total of $50K per year, and then redirecting the other $50,000 toward the loan principal. So there's again, different strategies or different approaches you can take all with the same policy. This is something we want to keep our finger on the pulse of as the years pass. And this is the case if I'm looking at large loans, because the topic of this video is what? Flowing all of your income through a policy, or smaller loans, or if I have a policy on a smaller scale, meaning I'm not flowing all of my income through a policy, but maybe I make $400,000 per year and I'm funding it with $100K per year. I'm taking large loans, but I still want to be able to see what the cost to borrow is compared to the growth rate on the policy. So let's take a look. We'll look at policy B, and we're going to look at a loan scenario here. So this is a loan workbook that allows us to mimic policy loans. It's meant to model cash value collateral loans. But here we go. We've got policy B, funding it for 25 years, 1090 design, annual loan, loan repayment. These are the two columns we have control of. We can also adjust the loan interest rate if we want. On the right, under blue, we've got the yearly cash value growth and then the annual interest payment. What this will allow you to do is see year by year, what are you getting from the insurance company compared to what are you paying the insurance company. The two columns to the right, total gain on cash value compared to total interest payments, allow you to see what's the total amount of earnings I have received from the insurance company, and then what's the total amount I've paid them in loan interest. And then the death benefit with a loan outstanding, this represents the net death benefit that would be paid out if I die with a loan outstanding. So let's look at some loans here. If I'm going to follow the strategy of taking income out every year, well, here's my LTV, 95% of cash value. Let's assume you're going to take $85,000 per year. Can you do that? Yes. But the thing is, what I want to hit on here, if we just go through year 25, what would your cash flow be in this situation? What are you actually dishing out of pocket? You get the $100,000 per year in funding. This column is also out of pocket, the annual interest payment. You don't have to pay the interest, but if you did it in a case like this, that's going to get very close to zero, and you won't be able to loan $85,000 each year. We'd have to run the numbers and illustrations, but we do want to pay the loan interest if we're able to. I would actually recommend reducing the funding in order to be able to allocate more funds toward the interest payment if I'm in a situation where I can't do both. But here, like this gets high after a while. When we look at it, here's what I'm paying every year in addition to the $100,000. So if my income is increasing and I've got excess funds to handle that, I could look at that and say no problem. But if I can't, I want the awareness up front, don't I? Also here, if this is how much I need to live off right now, the $85,000 per year, will that be the same next year, or 5 years from now, or 10 years from now? It likely will not be. That is going to increase as living expenses increase. So I do want to account for that. Now you've got some equity built in here so you can do that. But again, we just want to see the numbers and ask questions around them as we look at these models to see, is it really realistic for my situation? So here, what you could do is at some point we would want to repay the loan. Could begin to do that down here because we're paying right now $100,000 per year in interest. So if you begin to repay it, another $100,000 toward the funding, it's going to take a long time. There we go. All right. And that's too long, in my opinion, because I would want to most likely be using the policy for income potentially at that point in time. So what we could do here is look at an alternative strategy. Why don't we look at policy A? Can drop the values in. And this is the 10-year funding option. Stronger growth, and it's also more conservative. First year, loaned 85. So now what we can do is this. So we funded $100K per year for 10 years. Loaned $85,000 per year for 10 years. At 5%, I've got the loan interest. What's interesting about this, I can see year over year, what's the cash value growth compared to the interest payment. Early years, I'm paying more in loan interest than what I'm gaining on the policy. Eventually, the gains exceed the loan interest based on these dollar amounts. We can adjust this and make it look better or worse. But by year 11 here, how much am I paying in loan interest? 46,000 and change, let's call it 50. I'm going to round up. What I'm going to do here is when I'm no longer funding the policy, assume we begin to apply $50,000 per year toward the principal. While I'm still doing what? Loaning $85,000. $50K per year in principal payments while I'm still taking income. I know this is confusing. Here's what I want to hit on. We're putting out $50,000 per year in cash flow toward the loan repayment and also the loan interest payment. Now, if I'm going to continue to loan $85,000 per year, what's going to happen? The annual loan you're taking is exceeding the loan payment. Now, one might say, all right, well, if I'm not pumping my $100,000 per year into the policy, then I don't need to borrow against it anymore. I'll just redirect the cash flow toward the policy. And what happens? Well, eventually I pay it off, and then I see it restored, meaning I've got access to the full amount of equity as if a loan was never outstanding in the first place. No, that's a lot of information. Main point is having awareness on what the numbers look like before executing the strategy will go such a long way, especially if you're looking at a large percentage of your income or a large dollar amount in general. If I can see the numbers first, I'll have awareness on if it is a good idea or not. So I do hope this helps. Let us know if you have any questions at all, and we'll talk to you soon. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.